Are you a trader who is making money most of the time? If so, then this video is not for you. Skip it. I'll see you in another video. If you are a losing trader giving your hard-earned cash to your broker or to other traders like me, then you are in luck because this video is for you. Believe me, I know the feeling. It's very frustrating. You're watching charts all the time. You're developing strategies only to lose money at the end of the day. It feels like you're never getting the upper hand. The market is rigged against you, and whenever you buy, the market tanks. Whenever you sell, the market goes up. But what if I told you that there is a workflow that takes you from losing to a winning trader? And it's not a one-of-a-kind strategy or a magical indicator. It's a workflow that takes you step by step to build robust strategies, put them in a portfolio, and trade that portfolio profitably. That is what I'm going to show you in this video, is how to start from zero and end up a profitable trader. In fact, if you follow this workflow and still end up as a losing trader, you should quit trading, because obviously trading is not for you. By following this workflow, you gain a huge advantage over every other trader because you have a system to produce strategies and test them for robustness. You have a system to construct portfolios, and you have a system to trade with risk management. There is no single trade that's gonna wipe your account. You don't need to watch news. You don't need to watch charts at every minute of the day. This workflow will make you a consistently profitable trader. So if we imagine that this is our goal, the mountain is the trading skill, and the top of the mountain is where we make money consistently. And you are here somewhere on this journey. And why this is important? Because from talking to many of my students, many of the members in my community, I noticed that, yes, everybody in the back of their head, they want to make money, but usually the goal is not aligned with that target. So from one of my conversation, the person wanted to make money in the Euro USD market. And that is not the goal of making money. That is the goal to succeed in that market, which is totally different than making money. Because making money in the financial market means I don't care what the market is. I don't care what the strategy is. I only care about making money. So to me, most importantly is how much money I'm making compared to my drawdown. And if that happens to be on crude oil, who cares? But most of traders, they have this goal not aligned. So first, this should be your target, is to make money. It's not about making sexy strategy. It's not about trading on 1 minute, scalping and showing your profits to your friend or TikTok or whoever. It's about making money, which is totally different, as we will see from working through this workflow. Also, I want to emphasize that this is a skill. Anybody can get this skill. Of course, you need to learn how to do this skill, and you need to practice. So yes, anybody can do it, but most of you will not do it, which is totally fine because not everybody is meant to be an algo trader. So we can split the trading skill mountain as follows. This is where we want to be. We want to make money at the top here. And we need to start from the base. So the way it works, we need to find a market edge. This market edge is extremely important. Now let me define market edge. You see, every market has a characteristics depending on the people trading that market. For example, the traders and the funds that are trading crude oil are not the same who are trading, let's say, interest rates. And the fundamental drivers for agriculture futures are not the same fundamental drivers for interest rates. Let me give you a simple example. Let's take Coca-Cola Company, for example. Coca-Cola Company, they sell all over the world. That means they collect their money in different fiat currencies, but they report all their earnings in US dollar. So if Coca-Cola today sells in, let's say, Turkey, which they have big inflation right now, so they will sell locally in lira. And if they convert that lira to US currency, they will lose because the lira is depreciating. And when they convert that money to US dollar, it will not cover the original price. So what they do is they hedge. That means they will take a position in USD dollar against the Turkish lira as a hedge, not for that trade to make money. So that's totally different than a trend following hedge fund that's taking a short position on lira long term. So you see, the drivers for these two people who are trading that market is totally different. Again, it's the same for the oil producers than the oil consumers. The same goes for the coffee producer than, let's say, for Starbucks or Tim Horton or any big coffee chain. They need to make sure that they have a stable price for that coffee beans so they can make sure that they have a stable price for their coffee cup. And that is totally different than, let's say, for a trader like me who is taking a position 3 days or 5 days or 7 days, or for a hedge fund that's building a position over a couple of months. And because of all these elements and many more, every market will have distinct characteristics that is not the same in other markets. And that's what I called is market edge. And some markets have a huge prominent market edge, and some markets just sits in the middle. I can bring this even closer. If you have kids, even though the kids have the same parents, same house, but each kid has a different characteristics. And this is what the market edge is. And to be a successful trader, you need to build strategies for this market edge. You need to exploit this market edge to be profitable. To further go into market edge, please watch these two videos I highlighted here. I have more videos on the channel, but these will bring this idea and make it very clear to you. And from many videos on my channel, you'll find that the S&P 500 works really well with mean reversion strategies long, and the natural gas works really well with mean reversion strategies short. Now, if you test this on all the markets, you will get a chart just like this. So this market here will be good for breakout, and this market here will be good for mean reversion. And you'll find a lot of markets that sit like in the middle. They have no clear edge on long or short or mean reversion or breakout. But many other markets will have a really clear market edge. And those markets are the ones that we want to develop strategies for. We don't care about this section of the market. And unfortunately, the Forex many of the Forex pair fall here. And that's why most Forex traders, in fact, 98% of Forex traders lose money consistently. I, from my side, never knew a Forex trader that made money consistently. So yes, they made money this year, maybe next year, and then they lose it all the third year. Now, I'm sure there are Forex traders out there who are making money, but let's just say this is an extremely difficult situation, and you are much better off trading other markets because you can easily find an edge in other markets. So like I mentioned in the previous slide, the S&P 500 has a huge edge on the long side using mean reversion style. And the natural gas has a huge edge on the short side using mean reversion style. If you don't know this, then you will bang your head against the wall trying to find a short strategy on the S&P 500 or a long strategy on natural gas. That doesn't mean you cannot. I'm just saying it's going to be extremely hard to do it. Well, like you can do it in your sleep, developing a strategy long on the S&P 500 and short on natural gas. And this just proves my point. This is the natural gas market, and I have this strategy that will go short based on these signals and will exit after 3 days or if we have a profitable close. So look at this. So condition 0, this is the first one here, is we will just go short any day of the week. So we'll go short. Once we are profitable, we exit. If we are not profitable after 3 days, we exit. So we have 1,300 trades. And look at this. We are already $190 in profits. This just proves my point. Like, it doesn't matter what you do on natural gas. If you go short, you make money. And here I picked 5 mean reversion strategies. These are not optimized. These are just the typical values for mean reversion strategy. So this is if we have 3 closes up in a row. Now you can see this one says count if close is greater than the previous close for 4 bars. So that what I'm saying is in the last 4 bars you have 3 up closes, then we will go short. So it basically gives you more trade than to restrict it to 3 bars up in a row. So this just gives it more leeway. You're still 3 bars up, but in 4 bars, period. And then the next one is really simple. RSI of 2 bars is greater than 75, we short. This is the high, is the highest high for the last 10 bars. And you can change all these, by the way, like it doesn't have to be 10 bars. It could be 9, 8, 7, 11, 12, whatever it is. And this is the close above the Bollinger Band. Again, you see here I'm using 1.5 standard deviation just to get more trades in. And this is my ultimate C oscillator. And again, I'm using greater than 65 just to get more trades in. Now, why I want more trades in? Because when I develop, which you will see in the workflow, we usually going to add a filter. So I want more trades in all the time. I don't want the best strategy immediately with a signal. I just want good strategy with more trades so I can then add a filter to enhance those trades. And this is the major block in our workflow. So you imagine the base of the mountain is finding market edge. So once you test for market edge and you find it, then you'll start building strategies like this. So we will divide our strategies by the style, so breakout and mean reversion. And each style has the short and long. So with breakout, we'll have short and long. With mean reversion, we will have short and long. And of course, these markets are just samples. This doesn't mean that the currencies will work well on short mean reversion. It's just I'm giving you an example of what you will end up with. You will end up with many strategies on many markets, but built specifically for their edge. So we are exploiting the edge of that market, which makes it very easy then to get a robust strategy. So what you will end up is this, like we will end up with different direction, different style, different market, different time frame, and different metrics. Also, a big part of market edge is seasonality. Again, due to multiple fundamental reasons, a lot of markets have seasonal patterns inside the year. So this could be over monthly, weekly, daily, or intraday. Now, because algo trading usually associated with short time trading, and obviously that's what I advocate, because you can get more signals and you can generate more profits. That doesn't mean long term is not good. It's just in this case, it is really good. So we need to find the market edge for that market intraday. And again, here I highlighted 2 videos on my channel that discusses that intraday seasonality or intra-week seasonality. And the pattern for market seasonality, if you test it on many markets, will be like this. So it's like this. And this is the seasonal patterns. So some markets will have huge patterns like this one. And then some markets have small patterns, and some markets have patterns, but they are not usable, the one that sits in this part. So yes, there is a pattern, but it's not profitable enough to build a strategy out of. So here is the gold market, and this is the intraday pattern for gold market. As you can see, it starts from Sunday about 6 p.m. I think, and ends on Friday about 6 p.m. And this is the trend of the market. So you can see clearly we have a short pattern on Monday and a long pattern either on midday Friday, or you can start it from Thursday night. While during the week, there is no obvious pattern. Now, this pattern can be exploited. So you can take this pattern and build strategy out of. Go short on Monday starting at 2 a.m. and then close that trade by 4 p.m. That is a pattern on gold that you can use. Not only that, let's say you have other strategies, you can add this as a filter that on Monday, if you get a long signal, do not take it, because we know Monday is really good for shorts on gold. Again, watch these videos to cement your idea about seasonality and add it in your workflow. Now, just as a reminder, we are still in this trading skill mountain at step 2. We found market edge, and now we are developing strategies using the market edge that we found on each market. Also, as a reminder, the market edge is time specific. So if you find a market edge on hourly, that has nothing to do with the daily. Sometimes they overlap and they correlate, but it's not necessarily the same. So now that we found market edge on many markets, we found seasonal patterns on many markets, and we want to develop strategies for them, we need a software to do that. And you can, of course, do some of them in Excel, but most of the time you will need some type of platform. And what platform you pick really doesn't make a lot of difference. I mean, it's going to be up to you which platform you are comfortable with, which language you want to develop for, or if you want to use a graphical interface. And here I have listed some platforms. So it's either going to be a desktop application or SaaS. SaaS means it's basically on the web. You subscribe to a platform and you log in on the web and develop. So let's start with desktop application. If you want to get into coding, then I think these are the current top. TradeStation or MultiCharts. I use MultiCharts. Trading Technologies, ADL. This is a like higher quality, of course, more expensive. Then we have Ninja Trader, is very popular, Thinkorswim. Python is really, really good if you want to get into coding because it's very simple. There is a stable amount of libraries that you can use. R is the same thing. MetaTrader is awful, but it's very popular, so I put it there. But I don't recommend anybody that uses MetaTrader or get into MetaTrader. If you can skip it, go ahead. TradingView is really a charting, but they have Pine script, which is getting stronger day by day, so it might be good. Now, no code, meaning that you don't need to learn coding, but just know that coding has a lot of advantages. So here I put the advantages. Coding brings you an edge because with coding, you will have extra edge to develop custom strategies. It's not a canned strategy. It's not RSI 14 below 25. I can do 3 bars of RSI below 20, 3 bars in a row of RSI below 20. That only can be done using custom coding. Now, this is just an example, but custom coding allows you a lot more freedom. Of course, you need to learn coding, but that's why it has an edge, because not many traders, in fact, most traders, will not be able to code. And of course, you can add automation, you can combine strategies in the same code, test unique ideas, and so on and so forth. Going back to our no-code platforms, currently I picked, these are the best that I know. It's StrategyQuant X, and GSB, Adapt, Trade, and Build Alpha. These top 4 are what I call is data mining packages. Now, these are no-code platforms, meaning you pick and choose indicators and conditions in a graphical interface, and the platform will spit out strategies that you then need to take to test for robustness and so on and so forth. They all suffer from one big problem. None of them connect directly to the markets. All of them take the code and bring it to another platform to trade, and that will create discrepancy. Now, StrategyQuant X is moving in the direction of moving directly to connect to the markets. They currently do this with stocks only and using a special type of orders. So they are, I think, on the right path. And I think I've heard that Build Alpha might be doing the same thing. But Adapt, Trade, and GSB, they are, to my knowledge, they are not. Now, I also put Season X there because Season X kind of also find patterns, and you can then take that pattern and test it in your trading platform. Although they don't give you the code, but you know exactly the time and the hour to get in and to get out. Well, I don't think the hour, the day, because they don't have the intraday seasonality it's another module for Bloomberg. Now, when it comes to online, so we have some contenders to these desktop platforms. So currently, out of all these desktop applications, StrategyQuant X has Algo Cloud. So Algo Cloud is like the nucleus of the SaaS software online. They're basically shifting StrategyQuant X engine to be used on the cloud. And it doesn't have all the features, but has many of the features. So that's why I put Algo Cloud here. You see, I put Algo Cloud here because now it's part of this no code on the web. And I put here also TradeRun. Now Clio and Capitalize, they are, I think, the most advanced in this category, at least from my testing. But, you know, these will change. Of course, there are more platforms that I don't know about, or they probably will come in the future. So you need to keep an eye out. Now, I think the future is this. The future is these platforms online because they have an advantage, which is they can reiterate with small updates, while the desktop application usually are not. Also, since these are already online, I think it will be a lot easier for them to connect to trade online. But just to keep an eye, these are the current platforms that you can use to develop algo strategies using the workflow that I'm showing you. All these are able to develop using my workflow. Of course, some will be much better at it and some will be less good at it. So now that we built many strategies, many markets, many time frames using our market edge, which is the direction, the style of the strategy, and the seasonality pattern. And remember when I told you I'm looking for more trades because I can filter them out? Well, now comes the part to add a filter. And a filter is an extremely important part of any strategy. You always shoot for more trades in the beginning, but now we are shooting for quality outcome. Once we add a filter, we want a quality outcome. We want now this strategy to be really good. And filters, they come in all shapes and sizes. But I'm going to show you how I categorize them. So you see here, I have the StatWise market regime filters. These are proprietary filters. Only my students get those. And they are direction and volatility. The reason is most successful filters are direction and volatility. Yes, there are other really good filters, but most of them fall in these two categories, direction and volatility. And the other advantage that I put in my market regime filters is they are not optimizable. So you cannot optimize the filter. It's going to spit out a result, either works or it doesn't work. So if you think like the RSI, the stochastic, MACD, Bollinger Bands, these are oscillators because the price basically oscillates between the upper channel and the lower channel. And then we have directional, like let's say the moving average or the ADX, where basically it's a directional move or not directional move. Now the volatility, let's say the ATR, can be in the oscillator section because again, the price oscillates between a channel of high and low, where we have high volatility or low volatility. Other than that, then we have patterns, and patterns are distinct category. For example, most of you know the candlestick patterns where we have an engulfing bar. That's a 2-bar pattern where we have 1 bar and then another engulfing bar. And that pattern can be a filter for a signal. Now, bar generator is basically any pattern that you can find within 2, 3, 4, 5, 10 bars, it doesn't matter. And that's why I say generator, because you can generate infinite amount of patterns using, let's say, 5 bars. I can have 2 down, 3 up, 1 down, 4 up, the close higher than the open, the close higher than the previous 2 closes, and so on and so forth. It's infinite, actually. That's why it's bar generator, because you can generate as many as you like. And then we have volume, and volume is one of those unique indicators, and there are actually many unique indicators like the volume. Like, for example, the trend on the NYSE and the commodity index and so on and so forth. These unique indicators will be probably unique to some markets, but volume apply to most markets, where basically, again, we have a pattern of a higher volume, lower volume, and so on and so forth. And finally, we have date and time patterns. These are like, let's say, time of day, or day of week, or day of month, or even week of month, and so on and so forth. And I put here some examples that you can see. So this is market regime direction is bull, market regime volatility is falling. This is volume, so the volume greater than the average 20 bar volume, the ATR. Today is not Tuesday, this is a time filter. Today is engulfing bar, this is a candlestick filter. IBS is below 0.5. This is a pattern, and we can say this is a 1 bar pattern. Times between 9 and 11:30. Again, this is a time filter. You can actually build thousands of patterns. And in fact, all the previous graphical user interface data mining packages that I showed you, this is what they do. They put many patterns and they iterate. So for example, any patterns of the one I showed you, they can be 100 variations of them. So the volume is greater than the average volume of 50. I can do average volume of 40, of 30, or the average volume greater than the average volume, or the volume is higher than 2 standard deviation of volume, and so on and so forth. So it's unlimited. And that's what these packages are good at, is bringing these patterns and reiterate and finding a good fit for your strategy. The only problem is they do it randomly, but now you know how to do it because you are starting with market edge. You're not doing it randomly. So here is an example of pattern filters. So this is the natural gas. Remember, we put 5 strategies. I picked my ultimate C indicator as the starting strategy. So this is the ultimate C indicator default values. So you see I have many filters, and this is the return to drawdown. And you can see how we can enhance our original strategy by adding a filter. All these are better than our original. This is our original strategy. So 0 and 0, that's no filter. And you see we already have 19 strategies that performing better with a filter. And each one can be a different strategy. So this one, which making 204, and this one is making 175. These will be most likely not correlated. I mean, they could be correlated, but most likely they will be not correlated. And we can also see the difference in the win percent. You can see this one is 72, this one is 66. That's huge difference in the win rate. So the idea is to get many robust different strategies, even if we are using the same indicator with a different filter in the same direction, we will still get diversification by using a different filter. This is market regime, and like I mentioned, the best filters are usually direction and volatility. And market regime basically splits any market into 9 categories or 2 categories. Like you can use direction only bull or bear, or you can use it bull sideways and bear, or you can use volatile, non-volatile, or volatile, quiet, non-volatile. And then you can mix the direction and volatility. So you can split any market in 2 up to 9 categories. And then you can use that filter to trade or to only enter signals during that, and so on and so forth. So here is an example of the market regime. This is the crude oil futures. And this is the direction, which is this guy at the bottom. And this is volatility, which is this guy at the top. Now, I'm using these just to illustrate. The indicator, of course, doesn't print these. But just to show you that on crude oil, we spent 31% only in bull market regime. So I have the data here since 2006. So this is very good to know. Like most of the time, I am not in bull market in crude oil. And so I can either use this as a filter, or I can build specifically for that filter. We can go down and see this is the sideways. So we're spending 26% of the time. And then bear market is 43%. So we're spending most of the time in crude oil in bear market. Same thing here for volatility. Now I'm going to show you now natural gas, and let's see what we get. So natural gas, of course, you know this already by now. Look at this, 70% of the time it's in bear market. And remember, we know that we need to build short strategies on natural gas. And this is also another confirmation because most of the time we are going down in natural gas. Now, how we don't reach zero? Because we shoot up in spikes and then we go down. By the way, this is the same thing for the volatility index. So the volatility index on the S&P 500 that uses option, most of the time it's going down and then it spikes up to gain leverage and then keeps dropping down. And if I do the ES, and again, you know this already, most of the time we're in up market. But in the ES, look at this. So the range in points, so every day on average, we move 28 points. Not every day, every day in bull market. But every day in sideways market, we are on average at 40 points. So the range is a lot bigger in sideways market. And then the range even bigger in bear market. Look at this, 52 points. It's almost double the bull market. So in bear market, that means we drop a lot and fast because the range is almost double the bull market. So when you're doing short strategies on the S&P 500, you need to exit a lot quicker than the long strategies. Again, that will bring us to market edge. You see, this market is totally different than crude oil. The range is totally different. Then we need to treat these strategies totally different. And here, again, very important to note that in short strategies on the S&P 500, you have to exit quickly because the range is a lot bigger. So you need to capture that market range a lot quickly than the long side. Great, now that we have a number of strategies using market edge and a filter, and we need to trade them live in the markets. And here are where most traders fail because they don't test for robustness. Because think about it, how do you know that this strategy will perform on the live market just as it did in the backtest? And even if it did, you don't have the confidence to continue trading this strategy if it's in a drawdown. So this is why robustness testing is very critical. You need to stress test your strategy to make sure that it has a high probability of success on the unseen future data, just as it did with the backtest data. And I highlighted this video on my channel to go and see to understand how the robustness testing work. And I'll give you a short example here. So imagine this is the net profit and loss, and this is our variable. So in our example, let's say the variable is 10. And our net profit, let's say, sits here. Let's say this is 100K profit. What we want to test is if we change this to 9 or 8, will our profit fall here, like to, let's say, I don't know, 40K? Or will it stay very close to 100K? Let's say here, 90K. And what we are looking for is a stable parameter. We want all the changes. So if we go to 7 and we go to 10 here, we want the net profit to be above a certain level here so as not to have a huge drop. So in the future, that means when we change the variable, when we change the conditions in the future, which it will, we don't want our strategy to fall apart. We want to have a different result, but the result should be close to the original result. And if you watch that video that I mentioned, you will understand exactly what I mean. So now that you have built many strategies and tested a few of them successfully with robustness testing, you end up with really good strategies that are ready to trade. And here is another challenge that you are going to face, which is how to combine these strategies in a portfolio so as to manage risk. Because think about this scenario. If you have 5 really good strategies tested for robustness, but they all face the same risk in the market. So that means when that risk happens, all your strategies will suffer. So without proper risk management, you will again fail even with robust strategies. And the key is diversification. And by diversification, I mean the first slide that I showed you, which goes with direction first, style, and standard deviation, average trade, and then market. Market should be the last thing that you want to look at. because you want to go long and short, that those will be highly diversified than long and different market. Also very important, if you have a strategy, let's say on NASDAQ, that has an average trade of $100, and you have another strategy on the ES with an average trade of $500. Now, one loss in the ES at $500 needs 5 good results on the NASDAQ to equate that loss. So if your ES strategy fall apart, it will affect the portfolio a lot more than your NASDAQ strategy. So those needs to be taken into consideration. So once you do diversification, now you need also to equate the risk in the strategy. Here's an example I did. So if a strategy A has $500 on average, it makes $500 on average, and strategy B makes $100 on average. Obviously, this strategy will have a bigger effect on your portfolio. So strategy B has to equate that effect. And we can make these two strategies equal by increasing the position size. So for example, this strategy, if we are trading one contract here, then this strategy has to be traded with 5 contracts, because 5 contracts will bring this strategy to around the same average trade. And we want both strategies to have the same effect on our portfolio. Of course, that's not always easy, because you will need more capital to trade this strategy with 5 positions. But that is the proper way to do it, or we need to bring it closer. Let's say we cannot make 5 position sizes, but at least we need to make it 2. Or we need to replace that strategy with another one that brings all the average trades together very close to each other. And now the step where the magic happens. So you have all these strategies and they are tested for robustness and they are diversified across many market styles and direction. Now comes the part where we combine them in a portfolio and trade that portfolio. And here again, where many traders fail to build a robust portfolio, because they either go too aggressive looking for net profit, and usually they face huge drawdowns, or they go too conservative and they don't make as much money. And the key here is to be balanced. You want to make as much money with the lowest drawdown. And that happens only by mixing the right strategies. And the more strategies you have, the better it is. Because in a portfolio, you add the profits, but not the drawdown. So let me show you this example. Here is the net profit plus and minus. This is time, and consider each line is a strategy. So the green one is strategy, purple and red. And let's say each one is making 50, 48, 47. So in total, they are making $145,000. So I add the 3 profits is 145. But look at the drawdowns. So the drawdowns, they don't add together. Of course, they will if they overlap, like this one. So this one here, strategy purple and strategy red, they combine and they will have a bigger drawdown. But here, for example, the green is alone. Here, example, the purple is alone. So we don't add all the drawdowns, but we definitely add all the profits. And that is the magic of a portfolio. And the more strategies that are not correlated, meaning they are diversified across direction, style, time frame, and market, the better your portfolio will behave. You will have a smooth equity curve with lower drawdown, and you will have a very high return to drawdown ratio. And here is an example. So remember the natural gas strategy that we did. So here is the natural gas strategy short. And then here is an ES strategy. This is the RSI strategy. And also remember I showed you the gold in the beginning that has a seasonality pattern on Monday. So this strategy, shorting Monday on gold, all of them has a filter. All of them are robust tested. So this is the portfolio. And look, these are only 3 strategies. And this is the most important part. This is the correlation on weekly basis. So it's almost 0. And the reason it's almost 0 is because the natural gas is short, the ES is long, and the gold is intraday. So it's trading on Monday, intraday, and exiting the same day. And that's why the correlation is so low. This is the trade analysis. So we see we have short and long, more shorts because remember the gold is also trading short. And overall, we are 62 profitable, 62% with about $400 on average. This is the breakdown by symbol, and you can see most of the profits coming from natural gas. So natural gas average trade is 702, and the ES average trade is about 500, and the gold is about 120. Now, why the gold is 120? Remember, we are trading intraday, so there is not enough range to capture. So, of course, we can increase this by increasing the position size on the gold. And this, of course, will increase our drawdown and our net profit. And then we need to look at that and balance it with our portfolio. Now, of course, this is an example. You don't have to mix the intraday gold with these strategies. And now comes the final part. So we started with market edge, seasonality, adding filters, testing for robustness, looking for risk management, combining in a portfolio. And now comes the part where we need to find out how much money we need to trade a certain portfolio. Remember, with this workflow, you will end up with many different portfolios. And by the way, never trade a single strategy, always a portfolio of strategies with, I would say, minimum 3, but I would shoot for 8 or 10 strategies. Now you need to find out how much money to be able to trade this portfolio, because even with the best portfolio, if you don't have enough capital, you will fall in a drawdown where you cannot take a new signal. And I highlighted this scenario very well in this video. So go and watch this video. Do you have enough capital to trade? Because this shows you practically what happens even with a robust strategy. Like you have a good strategy, it's robust, it's tested, it's profitable, but then just because you don't have enough capital, it will go to a drawdown at some point and stop trading because you don't have enough capital to take the next signal. And this methodology using Monte Carlo analysis is the best methodology to find how much capital you need. Also, it's very good to target a certain drawdown or to target a certain profit per year. And this is the whole workflow to become a profitable trader. This is a tested and proven workflow to work for all traders. Of course, you still need to study all these videos to practice and then become a profitable trader. This is a skill. Like any skill, you need to learn and practice. And if you want to take this deeper, you can take my course, the Algo Trading Masterclass, which depending on what time you're seeing the video, probably it's open, probably it's closed. If it's closed, you just sign up for the waiting list. And if it's open, you are more than welcome to look at it, view it in detail, and ask me any questions you have. ATM has been out for more than 2 years with hundreds of students and many of them achieving great results, many of them taking part of this workflow that I showed you and incorporating in their workflow. Because remember, there are hundreds of ways to make money in the financial market. This is only one of them. This is my workflow. And you can take it all or take part of it and use it in your workflow. The target is to make money. That's it. The target is not to be the best trader. The target is not to build the sexiest portfolio. The target is to be profitable, and you can build on that, reiterate on that, add position sizing, and grow and grow and grow. My goal is to make you a profitable trader, and this is my methodology. If you like this video, then you will love the next one.